now for more on the reason behind the Bank of Korea's decision to keep the country's interest rate steady, we're joined today by Professor Lee Yoonsoo, Professor of Economics at Sogang University. Professor Lee, thanks for joining us this morning.
Thank you. Good morning.
So, as widely expected, the central bank has decided to leave its key interest rate unchanged. What's behind this decision?
So there are several reasons behind the decision to keep the rate unchanged at 2.5%. First, external financial stability, particularly the exchange rate, has become a top priority. The Korean won has become volatile recently, partly due to the uncertainty over trade policy, especially the questions surrounding the $350 billion investment agreement between Korea and the U.S. In this environment, the bank wanted to avoid adding further instability to the currency market. Second, the government has just announced very strong measures to cool down the housing market. The BOK has repeatedly cited elevated home prices in Seoul and the surrounding market as a major concern. Cutting rates now could have sent a wrong policy signal and fueled renewed speculation in real estate market. Third, the growth inflation outlook gives the bank some room to wait because the inflation is still average 2%, roughly in line with its target. So the decision was a very cautious one, aimed at maintaining both financial stability and housing market stability. And there is still large uncertainty remains, so we have to watch out.
Right, and when can we expect the central bank to start cutting rates? Could it possibly happen next month?
Yeah, there is a strong market consensus that BOK could begin cutting rates as early as November 2025, because the recent poll by Reuters and other medias indicate that 25 out of 31 economists expect the BOK will lower its base rate by 25 basis points from 2.5 to 2.25%. The main driver will be Korea's weakening domestic demand and the heavy interest rate burden on households and small firms. At the same time, the inflation has slowed to around 2% range, close to the BOK target. However, the bank will move cautiously. The key condition for a rate cut is confirmation that housing prices are stabilizing, since the renewed real estate speculation could undermine policy credibility. Another factor will be the direction of the U.S. Federal Reserve. If the Fed signals another modest cut in coming meeting, this will give the BOK more room to follow.
Right, and speaking of housing prices and the housing market, like you just mentioned, last week the government rolled out stronger measures to tame housing prices, tightening mortgage limits, and designated all areas of Seoul and Gyeonggi-do Province as regulated zones. How is the housing market reacting to this, and do you think these measures will be effective?
Yes, these new housing measures announced on October 15 were among the toughest we have seen over years. All of Seoul and large areas of Gyeonggi Province are now regulated, and you need a permit to buy a house apartment in these areas. And they also sharply tightened mortgage limit, especially for homes priced above 2.5 billion Korean won. The market has cooled dramatically in just 1 week. The transactions of high-end apartments fell by nearly 90%, and even mid-prices houses are seeing lower asking prices. These policies will likely bring short-term stability and curb the speculation, but the market thinks that these effects may be only temporary. In the medium term, structural imbalance still remain. Housing supply is still limited, and the weak sales could push rents higher as a lot of landlords shift from jeonse, that is Korea's lump sum large deposit lease system, to monthly rent. The jeonse market has come a lot of pressure, getting a lot of pressure. So this is very difficult for tenants to find affordable long-term lease. So if transactions stay weak for too long, we could see rental pressure rise. So while these measures may be working for now, as long as the structural imbalance between supply and demand remains, the risk is still remains in the market. So eventually, wealthy cash buyers could return once the market adjusts, and that may create another round of price rebound.
Right, and while that's happening, gold prices hit record highs recently, but it dropped over 5% this week, and this was the steepest daily drop in almost 5 years since the pandemic. What's behind this?
Yes, the gold has been surging to record high this year, especially second half of this year. But the drop was very dramatic, and there are several reasons behind the reversal. First, the gold metal had become extremely overbought after its rapid rally. Such conditions usually invite profit taking by investors. Second, the appeal as safe haven asset has weakened over time. There are signs of improving trade relations between U.S. and China. Plus, there was a modest rebound in risk asset. This reduced the urgency for some investors to hold gold. Third, the U.S. dollar has strengthened recently. This tends to weigh on gold because gold becomes more expensive in other currencies. And there was speculation that the interest rate cut by the Federal Reserve may be pushed out, but I think this speculation is disappearing. So overall, the plunge is likely a technical correction, and we saw that the sentiment can shift very quickly. But this is not a collapse of the investment thesis for the gold. The long-standing fundamentals for the gold rally, such as inflation concern, geopolitical risk, and the central bank demand switching their diversification, these factors remain supportive, so investors need to monitor these factors closely over time.
I see. All right, Professor Lee, thank you so much for your time and insight today. We appreciate it.
Thank you very much.